2024. I'll call the Surgeon Water Board Pension Committee to order. Special counsel, please call the roll.
Director Pacho,
Here.
Director Scholas, Director Markowitz, Director Anthrop, Director Shine, Ms. Shine,
Here.
Mr. Davis, Ms. Johnsey,
Here.
Mr. McBool. Sure, we do have a quorum.
We do?
We do.
Okay.
I'm sorry, we do not have a
No,
quorum.
no.
Director Anthrop is not here,
Right.
so.
Okay.
But we have no action items, so we may proceed with the
Okay,
presentation items.
Thank you. We have two presentation items. The first is from Marquette and Associates, and they will present the executive summary of September 2023 market performance. Quaker, floor is yours.
Okay, great. Good morning, everyone. And I see a couple of new faces in the room. So by way of a quick introduction, my name is Kwaku Obed. I'm a managing director and a partner at Marquette Associates, the investment consultant firm that's putting together the materials that we'll be going through in a moment. So a couple of things for today. We're going to go through an overview of the portfolio and the markets for the month of September. And then we'll also be discussing and reviewing some searches with respect to the asset allocation. So that's the goal for today. So with that, we jump into the executive summary. September, so the last time I was here, Gray just asked when was the last time I was here. I believe it was August. The market was a much kinder place in the month of August. September, we saw a pretty meaningful sell-off in the market. And to really sum up the reasons for the sell-off, we can think about market sentiment. Market sentiment, i.e. what are people thinking about 2024? And then Fed action. So the Fed, as we know, has embarked on a very aggressive interest rate cycle, hiking cycle. That has been to combat inflation. There's a negative correlation between where interest rates go and the performance of fixed income. There's also a negative correlation with very aggressive interest rate cycles with the performance of the equity market as well. The reason for that is as interest rates go up, it's more expensive to borrow. The more expensive it is to borrow, the more of a dampening effect that will have on the economy. So that's why the stock market is essentially looking at interest rates going up in a negative way. And that's why fixed income is losing value because of the negative correlation between interest rates going up and the value of your fixed income instrument. So with that, when we look on this page, we take a look at the U.S. market, the S&P 500, a good barometer for the U.S. market. That was down just under 5% for the month of September, so a pretty meaningful sell-off. The one thing to point to here, which is the saving grace for the market whenever we think about investing and being long-term investors, even if there is a short-term pullback, and we can use 2008 as an example, you can use the COVID sell-off as an example, these are relatively recent examples, longer term, the market is still extremely strong. So you're looking at a one-year return of 13.1%, I should say a year-to-date return of 13.1%, and a one-year result of 21.6%. So again, a sharp sell-off in September, but we're long-term investors. As long-term investors, that should help soften some of that negative news for the month of September. So the market is typically more positive than it is negative over the long term. So while over the short term it's negative, hopefully that calms some fears with respect to where we think the market is going to go. As we look at the international markets also sold off. You're looking at a negative 3.2 for the ACWI US. EFI, which is developed markets, down 3.4. As I noted earlier, the fixed income market has definitely gone through some challenges, and that is correlated with the Fed's interest rate policy. So if we look at the middle where it says yield curve,
Wait a minute, I have
what they call.
Hold on, got a question.
Yes.
So what's really interesting to me about the regional returns is that everything is contracted with the exception of Brazil and India, which are a lot of people are sort of putting resources into embedding that those with the population center growing in India and with Brazil trying to establish itself as a power in this hemisphere. Do you think the bumps there are going to be enough to offset worldwide contraction, or What are your thoughts on that?
So the quick answer is, if the quick answer is no. It would be too much for those two emerging economies to carry the brunt of the global system.
Mhm.
And to really cut to more of a granular point on the sell-off. The sell-off has really been driven by the U.S., the dominant economy in the world, Fed raising interest rates, uncertainty, heading into a very contentious political environment. And then China has also had its growth prospects revised downwards by the IMF. So combining China and the US, significantly bigger in terms of the impact on a global scale versus a Brazil and India. The good news, though, is if you are invested in, let's say, the emerging markets, you have emerging market exposure or international market exposure, the managers based off the guidelines could in fact look at Brazilian or Indian exposure, and that would be a way to buoy up some of the losses we'd expect to see coming in from China and from the US. But China and the US, again, really just dominates the global market, and that's going to be more significant than those two countries just mentioned.
And I'd like to note for the record that Director Howard is in attendance at the pension committee as well. Thank you.
So looking at fixed income where it says yield curve, right on the top of the page in the middle, you're going to look at the shape of the yield curve. So the black line points to the most recent shape of the yield curve through the end of September. And the shape there is what's known as an inverted yield curve. The, I guess, importance or meaning behind an inversion in the yield curve is its predictive power. Typically, when you look at an inversion in the yield curve, it does mean that shorter-term prospects are viewed more favorably by the market. Longer-term prospects are discounted more. And that is typically a strong indicator for an economic slowdown or a recession. So kind of backing into some of the comments made earlier about the US economy, the shape of the yield curve is definitely one of those indicators that's given individuals, folks to pause with respect to the prospects for the US economy over the intermediate term, I should say. So this jumps into performance for the portfolio, and for the portfolio, a couple of things to put into context. So we just mentioned a market environment where the S&P 500 was down almost 5%. We think about the fixed income market, and typically we look at fixed income in positive territory when the equity market's selling off. We're not seeing that right now. Typically, there's a negative correlation between the performance of fixed income and equities, meaning that if equities sell off, fixed income does well. If fixed income sells off, equities do well. We're not seeing that in this environment because, again, the Fed's interest rate policy has put fixed income in a bear market, and then the equity market is also, looking to absorb what extra prices the cost of borrowing going up will mean. So we're in this strange environment where both equities and fixed income are both selling off. So as we look at the returns here, so negative 5%, we're down negative for the month of September in fixed income. The portfolio, its returns relative to the broad market have actually held up pretty well. We've done better than the stock market. We've done a little worse than the fixed income market. And ultimately, that is a sign that the asset allocation has helped protect on the downside. The year-to-date result of 5.2% does highlight that the portfolio has participated in the market rebound in 2023. So again, as we think about the behavior, the return streams in the portfolio, it is behaving in line with expectations. Later on today, we will be talking about some searches, infrastructure, private equity, real estate. The purpose of these searches are to get us closer to target on the approved asset allocation. In this type of environment where we're seeing equity market and fixed income market volatility, it's that reminder that additional diversification outside of the traditional markets is helpful for a long-term asset allocation. So that's really what this page is telling us. Performance over the short term, and then over the long term, even though we had a very challenging 2022, even though 2023 has been marked by more volatility, we're still looking at really good long-term returns, particularly in comparison to the index. So just wanted to put, again, the performance in some degree of context. As we look at the various composites in the portfolio, we're looking at the fixed income composite holding up pretty well, the equity composite holding up pretty well. The REITs composite has gone through a pretty meaningful sell-off in 2023, so it's not anything that we're doing. It's not anything that's happening in the portfolio that's out of bounds. Real estate is one of the areas of the market that's going through a short-term cooling off. The hotel segment of the market went through some challenges in 2020. No one was taking vacations. That has since rebounded. The knock-on effect is now with the office space where, Gen Z back to work, what the new normal looks like, across the country, offices aren't at their full occupancy. So office has definitely been a big detractor in the real estate market. When we think about the real estate exposure we have here, it's REIT exposure. So real estate investment trusts, REITs. These are liquid, daily traded REITs, so there is a correlation with the equity market. The type of real estate that we'll be talking about momentarily, that will be private real estate, so you're looking at less correlation with the equity market, meaning if the equity market sells off, you're not going to see that commensurate move in your real estate portfolio like what you're seeing today. And that's another reason why we're looking at additional diversification outside of equities and fixed income. Now, as we think about the managers in the portfolio, we get a sense of who's contributed from a positive standpoint and who has been a laggard, for lack of a better term. We see that the Fidelity Index strategy has lagged the index. Again, the reasons I just mentioned around REITs, correlation with the equity market, and then the real estate market also being in this cooling off period, that really explains the relative performance there. Ernest Partners and Fidelity have both held up really well relative to the benchmark. With Fidelity, a little more of the plus sector exposure as the Fed is raising interest rates has been helpful for that portfolio. And then with Ernest Partners, being more of a quality bent manager, but still deviating between value and growth to get you that core exposure has also been beneficial for them, particularly as the market has gone up and down.
Sorry, could you go back?
Yeah.
These are holdings or these are active managed tradings?
These are actively managed portfolios. So Ernest Partners is the name of the manager that manages the non-US equity or the international portfolio. And then Fidelity, they manage, or Pyramis, they manage the fixed income portfolio. So these are the institutions managing the underlying asset classes.
And what percentage are those asset classes of our total portfolio?
Okay, so let me jump here really quickly. So we do see here that the approved target weight is 25% for fixed income. Non-US is 15%. So it is meaningful when we think about the outperformance and underperformance from that standpoint. The overweights and underweights, nothing to really do here other than continue the conversation around asset allocation and managers for consideration. So when we look at the overweights and underweights, naturally there's a significant underweight to private equity. We have not made an allocation to private equity. And as a result of that, we have overweights in other parts of the portfolio. As we discuss private equity and assuming that we move forward with interviewing managers, hiring managers, we'll start looking at that underweight, drawing down in line with the managers investing those money.
You know my concerns about making sure who we work with in terms of investors. We've talked about that.
Yes.
And private equity can be notoriously terrible about that.
Yes.
And so I know that there are some funds where they're trying to get access to Black women firms specifically that are under attack in Georgia.
Yes.
Can we do something with meeting our needs by supporting those Black women that are actually trying to get access to capital to do some things and support them in their processes? Is there a way we can do two birds with one stone with that?
Yeah, so the quick answer there is, so you referenced the Fearless Fund.
Yes.
In Atlanta. I would say Fearless Fund, they have become a poster child for the culture wars going on right now. With the Fearless Fund, I won't go into it too much, but I'll say with Fearless Fund, there are managers in the portfolio. I mean, there are managers that we're profiling, I should say, that are blue chip organizations. They do have either diverse ownership or diverse leadership. And I would say that in the spirit of lifting the tide and having best-in-class performance. We do have candidates to meet that. In the case of fearless funds, that's kind of a nuanced situation where we wouldn't necessarily invest our monies with the fearless fund, even if personally we might agree with what they're doing. But the funds that we're profiling today, you're looking at blue chip organizations, really good institutions, long-term track records. They've raised several funds, and again,
I do not think it's an either or conversation.
exactly.
And I want to be really clear with that.
Yeah, and I was just about to say that when I think about investing, I never look at having diverse exposure as a way of diluting returns. I never look at it that way. Our firm never looks at it that way. So that was the point I was just about to make, that when we go through the candidates, particularly on the private equity side of things, it's not an either or discussion. These are good firms that we expect good things from. And yeah, I'll end there and take any questions you have as we're going through the search candidates. Yep. This is just a running tally of all the actions that we've taken. So again, nothing to do here. This is just an example of actions that we've sat down and discussed with the board. We've taken money from certain managers. We've added money to certain managers. And during this transition period in an asset allocation, it's nice just to have a checklist of what's been done. So that's really the purpose of that particular page.
Can you go back to the frequency? So when you see that evaluation in your top and bottom performers, what is the frequency of these actions? Like, how often are they evaluated? When do they have actions taken?
So we look at the managers on a monthly basis, but in terms of taking action, unless the manager has really deviated from what they said they were going to do. So here's an example. Right now, we are in an environment where growth is doing really, really well, value is underperforming. If we were with a high quality value manager, and that high quality, I'll use another example. If we were with a growth manager right now, and that growth manager was significantly underperforming, that would be cause for action. But more often than not, because we're doing the homework, because we're going through the search book and the candidates in a very detailed fashion, we typically don't take action on managers on a very frequent basis, because there's an understanding that even skillful managers, even the best managers, will go through periods of underperformance. And in the case of the top performers and the bottom performers, the market environment may be conducive to a very tough environment. Value would be a good example of that. So if we have a really good value manager, over the last couple of years, that manager would have struggled. It might be premature to axe that manager for literally doing what it was supposed to be doing, particularly as value has not bounced back. So there are a couple of situations where we would take immediate action on a manager. So if there is a key person on the team that leaves, and we don't have conviction in the rest of the portfolio management team, that would be an example. There have been examples where, headline risk, either someone significant at the firm has done something they shouldn't have, and that's cause for termination. And then going back to the investment policies will typically give you a set of guardrails that you can work with to look at a manager, evaluate a manager, and unless the performance is, lagging, let's say over a 1, 3, 5, and since inception basis, short-term dislocations, we take it in our stride if the short-term dislocation makes a lot of sense in the context of how the market's doing. So all of these actions, I would say, are really in line with moving the portfolio to the approved asset allocation, as opposed to growing impatient with managers and their relative performance. So to give you a few examples, the iShares portfolio, we ended up eliminating iShares, which is also owned by BlackRock, and going into the Russell 1000 Growth Fund. The reason for that was really just significant savings in fees and then lowering of tracking error. So an ETF tracks or trades daily. So as a result of the daily trading and in real time, I should say, that leads to more tracking error versus your traditional growth index fund. So that's one reason why we ended up nixing one manager and replacing them with the same type of strategy. With Prisma, that's a hedge fund. Hedge funds were not part of the new asset allocation, so the liquidation happened there. Vanguard and Fidelity, the real estate funds, that was really just based off fees. So all of these movements here have really been based on the asset allocation as opposed to any managers that have really dropped the ball and they need to go.
And do we have like a report card basically for these over some chunk of time that we
Yes.
evaluate as well? I know you look at it monthly, but is there like an overview?
Yes. So the broader performance report is an example of that. So that will have performance going through this since inception period. So whenever the manager was hired in the portfolio. And then, we will look at performance relative to peer groups. We'll also look at performance as well as fees relative to peers. And all of those indicators allow us to assess whether a manager should be in the portfolio, if they should be on watch, or if any action should be taken. So the broader report will definitely have that information. Going to the asset allocation once again. So there was a legacy asset allocation. We approved the new asset allocation, and we're now transitioning to the new asset allocation. So today, when we think about the conversations that we're about to have, global infrastructure, private equity, and real estate, these are three segments of the market where we currently do not have dedicated exposure. Real estate, I explained that before, where we do have REIT exposure, but we're looking for private manager exposure in real estate. And then global infrastructure and private equity, we have zero exposure today. So those are the areas that we will discuss momentarily. As we think about global infrastructure and real estate, this just gives us a sense of where the monies are currently invested. So for infrastructure, we did put in place Cohen & Steers listed infrastructure strategy. For real estate, we did transition from the Vanguard product to the Fidelity product. So these are, somewhat placeholders for those asset classes. And then here we just point through other changes that were made in the lineup. So nothing to do, nothing to really report on, just to say that this is a rubber stamp or a proof statement of the actions that have been taken thus far in the portfolio. Also in the spirit of just making sure we document absolutely everything procedurally, we did issue RFIs for the private equity, infrastructure, and real estate asset classes. Once those searches conclude in the coming months, our goal would be to issue RFPs in these following areas: so non-US small cap, emerging markets, mid cap, small cap, and then core fixed income. So we still will have some more managers to take a look at, but right now we're focused on those three asset classes. So let me pause and see if there are any comments or questions regarding the portfolio, performance in the portfolio, before we jump into any other agenda items.
Yeah. Any additional questions?
I'm really interested in the infrastructure investment group because I think there's going to be a significant push in that coming up, especially as we lead towards the national elections. I think that's going to be a thing. People are going to try to use it to deliver, and I think that could be a good source of return for our employees.
Absolutely.
Okay. Then quick, why don't you proceed with the asset allocation transition plan and the summary of manager responses for real estate, private equity, and infrastructure asset classes.
Perfect. So we'll begin here with private equity. And as a quick summary, so private equity is an asset class that's different from your public equities. So public equities, you can think about your S&P 500, you can think about your international equity market allocations. Those are public equities. These are traded daily, they're on an exchange. You can essentially look at the performance of your manager on a daily basis. Private equity is a different asset class. These are deals that do not trade on the stock market. These are investments that are made really through networks, connections, the ability of a manager to access deals at favorable terms, favorable prices, and then turn around those deals to be profitable. You've heard the term IPO. Private managers will go and pick a company. The tech sector has been a really good example of that. They'll get that company to a certain size and scale, and then that company will go public. So that's an IPO, and that's really the bridge between the private markets and the public markets. In terms of an asset allocation, the private equity allocation, again, the goal here is to provide a source of returns for the portfolio. So you're looking at returns in the double digits coming from this asset class, but then the other benefit is less volatility over the long term with the traditional market. So if the equity market sells off, we have a sell-off like we did in the COVID era. You're not going to see your private equity portfolio go down by as much in a day. So it kind of helps smooth the returns of a portfolio along with adding to the overall returns of a portfolio. So I've explained the asset class, the purpose of the asset class in a portfolio. As we think about what we're looking at today, we did issue an RFP. So this is back in April of this year. We did go through an evaluation of the responses received. In terms of the RFP responses, we received, I want to say, over 30 responses. So the names of the firms that did respond are listed here at the bottom. So these are all the RFP responses. And the takeaway here is we got a healthy number of responses from the marketplace. Our research team took a look, and based off performance caliber criteria, these are the firms that we are looking to profile today and have more of a discussion around. With respect to the firms and what they represent, Adams Street is a majority-owned firm, so there's no diverse ownership, even though there are diverse individuals on the portfolio management team and in some of the underlying companies. Sango is a diverse-owned firm, and it does focus on investing on the continent of Africa. I will say this, when people typically think of Africa, unfortunately, blood diamonds and movies like that come to mind, less so than Coming to America or Black Panther for a more extreme example. But when you think about Africa as a continent, we just mentioned Brazil, India. There are parts of the world where you have growing demographics, a strong consumer base, and Africa is definitely on the next frontier. So Sango is a good example of a quality institutional manager that invests on the continent. We have Mesirow, again, not diverse owned, but ultimately a good blue chip option. And then underlying companies or folks within Mesirow, you may see diverse representation there. Exponents is diverse owned, so this is a GP stakes fund. We'll talk about that momentarily. And then Vista, this is the landmark Robert Smith firm, the guy that paid off all the student debt at Morehouse, as a quick reminder of who he is. That's a diverse owned firm. So as we look at all these candidates, again, the key takeaway here is blue chip, solid firms, and then a mixture of diverse and non-diverse owned. We have 3 diverse owned and then 2 majority owned firms in the mix. So as we think about the firms in the memo, I think the memo does a pretty good job of just giving a broad overview of the firms and what they're about. With the case of Adams Street, it talks about the history of the firm, when it was established, the spinoff from UBS. Sango, again, I mentioned Sango has been in the market for a while, so they were established in 2011. Obviously, to be established in 2011, to be in existence in 2023, and to be raising another fund is emblematic of a pretty good investment thesis that has paid off for investors. Mesirow, we get a sense of their history there. Started in 1982. Exponents started in 96. Vista in 2000. And then as we go through additional information on all of the different funds, you'll get a sense of what they're looking to do. So there's going to be a little difference across all the different fund options. Adams Street, this is going to be a global fund, so it's an underlying investment of other private equity allocations. Adams Street is going to go across the globe, and they're going to pick the private equity funds that they think will be the best funds out there. With respect to their expected returns, the diversification of the portfolio, and then ultimately how they're broken down geographically, you get a sense of the Adams Street portfolio from this particular page. With respect to Sango, very different from Adams Street. So when we think about private equity or any type of investment, you can have an investment that's more broad. It captures a broad market. and then you can have an investment that's more niche or more narrow. So Adams Street and Mezro, you can put those in the more niche category. Doesn't make them bad, doesn't make them something you want to walk away from, but it is more niche than, let's say, an Adams Street that is a combination of your primary, your secondary, your co-investments, your growth equity, and your private credit, meaning that within the whole spectrum of the private equity market, Adams Street will have its toe in a little bit of everything. In the case of Sango, again, Sango is a very specific investment thesis. It is definitely focused on high growth, focused on 8 to 12 African countries. And then when you think about the overall returns of the portfolio, 5 to 7 times return from an EBITDA standpoint, a pretty healthy rate of return that they're looking for. When we think about certain markets outside of the US, well, what are the themes that play out? The emerging consumer, food value chain, and then energy. So as we think about economies that continue to evolve, a lot of opportunity for institutional capital to help with the modernization of certain economies. Mezro, as I mentioned, is pretty similar to what we've seen with Adams Street. So pretty diverse in terms of buyout. There is global exposure in terms of non-US buyout, venture capital and growth equity, and then special situations. And then, like Adams Street, it's more geared towards the US, but there is some non-US exposure within the portfolio. Exponents is a little different. So with the last 3 managers I mentioned, Adams Street, Sango, and Mezro, all of these managers are investing in underlying private equity deals, for lack of a better term. So they're looking at specific deals, investing in those deals, and over a period of, let's say, 6 years, 8 years, 10 years, you're looking at the capital coming back from those specific deals. Exponents is different. This is known as they manage what's known as a GP stakes fund. And GP, that stands for general partner in the private market. So general partner, this is the brain trust. These are the folks that run the company, invest side by side with their investors, and these are general partners. If Swibno does invest in private equity, Swibno would be a limited partner in private equity investments. So again, Exponents looks to invest in general partners, i.e. they invest in private equity funds, firms, I should say, private equity firms, as opposed to the underlying funds. And the health of the private equity market, real estate market, infrastructure market, that's what Exponents is looking to really capitalize upon. The extra layer in the Exponent story is the diverse ownership. So they are investing in diverse owned GPs, meaning that their goal is to give capital infusions to diverse owned firms to allow those diverse owned firms to expand their operations and increase their footprint in the marketplace. And then Vista, as noted earlier, this is Robert Smith's firm. This is definitely one of your larger managers out there when you think about fundraising and fund size. Definitely has been a dominant and strong player in the technology side of things. And again, I think this really captures, I guess, the blue chip spirit of the managers that we're profiling and taking a look at. When we think about the managers, we've given a broad overview of the firms and what they do, the strategies. It's also important to get a sense of what the performance has been like. And when we take a look at the overall performance, you get a sense of what these managers, what these funds have been able to do over calendar year periods. Vintage years, kind of like for those of you that drink wine, vintage years point to the year a private equity fund is raised. So, a 2023 vintage year would be a fund that's raised this year. A 2024 vintage year would be a fund that's raised next year. So these just point to the years that these funds were raised. And again, we're looking at longer term track records with all of these managers. When we think about the fund size, the larger managers naturally will have a larger fundraise. So Adams Street, as an example, you take a look here and they've continued to increase the size of their funds. Sango, because this is a more niche segment of the marketplace, you're still looking at a large fundraise. So over 100 million, that's a pretty meaningful amount of capital, but it is more niche, so it's less than, let's say, an Adams Street. But more importantly, if you look at the distribution of cash, if you look at the IRR, which is the internal rate of return, it's a way of measuring private equity investment because it's just structured differently from your traditional fixed income or equity portfolio. These are really good returns that we're taking a look at for Adams Street as well as Sango.
Excuse me, can I ask you a question? I don't understand something.
Yes.
On Adams Street, we have every year listed chronologically. On Sango, we don't. Why is that?
Yeah, so Adams Street has been around longer than Sango, so Adams Street has raised more funds than Sango. So Sango only has 3 private equity funds that we can lean on from a performance standpoint,
I see.
and that's why.
So the vintage years are just the year in which they're established? Is that what you're saying?
Correct. So if you have,
Okay.
yes, so yeah, so that's basically it, yes.
And then the internal rate of returns over there are a lot less than the internal rates of return up above for the Adams one.
Yes, so the IRRs, you will see that for Sango, the IRRs, they have increased, but again, this is a, bless you, this is a niche allocation. So Adams Street, for example, has been exposed to more of the tech boom in the US as an example, more of the tech boom in Europe, for example. Sango, its focus is really on a growing consumer base and also an expansion of, let's say, essential services and goods and so on. So the opportunity set is not necessarily apples for apples when you think about it that way. The flip side is we've seen a tech sell-off. We've seen a lot of concern around AI. We've seen, for example, significant markdowns in the US and Europe because of interest rates going up. That is a headwind now facing, let's say, an Adams Street that a Sango isn't, and that kind of gives a little nuance around reading those returns.
But I guess what I'm asking is, as a trustee,
Yes.
how would I justify going with an internal rate of return and multiples that are much lower than for one company versus another? Because what we're talking about here is getting money for our employees at
Yes.
the best cost to the organization and the public.
Yes, absolutely. So one of the things that's important to note here is every vintage year points to a specific fundraise. So we can't invest in 2012, 2016, or 2019 funds anymore. The important thing to see here is with Sango, and this is true for every fund, whether it's Adams Street, whether it's Goldman Sachs, whether it's Morgan Stanley, whoever, the first couple of funds, you're typically going to look at rates that could be less than optimal because it's a first fundraise, the team is cutting its teeth, they're getting a sense of how things operate. And if you look at Sango, the important thing to look at here is the IRR has steadily increased. So it's gone from high single digit to double digit territory, meaning that they've continued to expand their network and their ability to really source really, really good deals and have monopolistic ownership over those deals. So we would expect for Fund 4 that continuation in IRR to go up. But as you correctly noted, that is a consideration that you have to have as a trustee. So one of the things we'll discuss momentarily is, okay, which combination of managers would make the most sense? If we're looking at, let's say, a Sango, we wouldn't say Sango needs to be your sole allocation in the portfolio. We feel that Sango, because it's more niche, would have to get complemented with a more broadly diversified strategy. We could also make the same case for exponents as well. We feel that exponents would have to be more, buoyed up with a more diversified allocation. Vista is very different. So the Vista Fund, probably one of the larger fundraisers we've seen in recent periods. Vista is an example of someone that could be a standalone or could be complemented by another manager. So as we think about the combinations of managers, that's a really, really important question as well. With Mesirow, you will see here, with Mesirow, you're looking at funds 2 through 8, essentially. And again, with the IRRs, the overall returns, a pretty good story there where we're looking at increasing returns, increased IRRs. Now for Fund 8, we will see a lower IRR, meaning that Fund 8 is still being managed, if that makes sense. So the life of a private equity fund is typically 10 years, going up to 12 years. Because this fund was just launched in 2020, the IRR is a little misleading because that's not the complete story. We're just seeing what's been realized, up until this point. In the case of Exponents, it is a first-time fund, so there isn't a track record with Exponents. Now, what makes Exponents a little different here is Exponents has built their business on being a manager firm. So Exponents was one of the first firms in the industry to really look to compile, put together, and build manager programs based on diverse manager ownership. So they have a very strong track record spanning decades of putting together structures, whether it's on the equity side, fixed income side, the private market side. They have had a good track record of building custom portfolios for clients, but this is the first time they're actually marketing that as a product in the private equity space. So that's why there's no track record for Exponents. And it kind of goes back to, if we think about the managers and manager combinations, if we were to look at Exponents, that would be a manager that we would definitely recommend combining with a more broadly diversified mandate. And then finally on Vista Equity Partners, we see here nice returns coming in from Vista from an IRR standpoint. As we think about, should I pause, or as we're good, everything's good? As we think about technology, AI, where things are going from that standpoint, this is the type of firm that will really ride that wave. And when we go back and think about the firms, the options, the candidates out there, in all fairness, I really feel that this is every decision we make is a very important decision for the portfolio, but this is the first time we're investing in private equity. The recommendation from this end would be to have the managers interview. Maybe we can do it virtually, just to be mindful of everyone's time. And B, I do feel that having an allocation to one manager would be too much of a concentration risk, particularly as this is the first allocation we're making
Within
to the
that
asset class.
10%. Yeah.
Yes, exactly. That would be way too much. So, rather than say, look, we need to hire this manager today and get the paperwork signed ASAP, this is a long-term decision. And as we think about making a long-term decision, here are the buckets we can put the managers in. So Adams Street and Mesirow, these are established firms, your mainstream firms, and these are broadly diversified portfolios that just give you that broad market exposure in private equity. When we think about your Sangos and your Exponentses, these are more niche strategies. So these are diverse owned, but these are more niche in terms of their strategy and their approach. So if we were to look at either of those managers for potential hiring, we'd recommend complementing them with one of the mainstream managers for an allocation. And when we think about mainstream managers, we'd also put Vista in that camp as well. Vista is also mainstream, very broadly diversified. The one thing I'll say here about Vista is they do have a close coming up, meaning that when these private equity funds go to market, there's a finite period of time where they're raising capital. Once that calendar period kind of goes past, you're not able to go into their particular fund offering. So with Vista, we may run up against the clock, just given the fact that they have a fundraising cycle that's pretty aggressive. But given the fact, again, we've gotten some pretty good questions from all of you, given the fact that I know that there are, with any board I work with, there are always going to be different interests with respect to doing the right thing, but how you go about it may differ from board members. So ultimately, my recommendation would be to bring these managers in, actually interview all the managers, and then really get a sense of what we've tried to lay out here, the different flavors of where we can get our alpha from, where the risks may be embedded in the portfolio, how those risks would be offset and managed by the managers, and then ultimately what would be the best fit for us as a portfolio.
I had a question.
Good.
On your table with Vista,
Yes.
and you were saying the annual fundraising that one.
Yes.
It goes to 2007, 2019. Then that 21 is that the fund size is quite a bit. You're in the billions that they're
Yeah.
raising on anyways.
Yes.
Is there a reason why, like 2019, you're at, which is 17.2 billion,
Yep.
and then it sort of took a pause as where as you look at Adams that sort of happen in consecutive years.
Yep.
Is there certain years that certain funds would say we would say fundraise certain year, wait a certain year, and then fundraising, and is there a certain methodology on when they solicit funding ties?
So you hit the magic word. So it is methodology.
Okay.
When you think about an Adam Street or a Mesereau, what they're doing is they're looking across the globe and then they are picking private equity firms to invest in. You're always going to have private equity firms across the globe. They're always going to be good private equity managers raising in any given year. Or the hope is, I don't want to guarantee that, but the hope is you have good managers raising in every given year. So the universe for an Adam Street and a Mesereau is, pretty infinite when you look at it that way. In the case of a Vista, as you can see, the funds have gotten bigger and bigger. And as you think about 2016 or 2019, if you're going to deploy capital, 11 billion in capital, and you're going to do that well, you want to make sure you're taking your time. And where private equity managers can run into trouble is if they get a little bit too greedy, where they raise a fund, let's say in 2019, let's say 2016, they raise a fund that's 11 billion. And then 2017, before they've even invested that 11 billion, they're already raising another fund, and now they have to put all that money to work. That runs into an issue of, okay, now are they getting the most quality deals? Are they just putting the money to work for the sake of saying they put it to work, or are they really taking their time to deploy that capital? So you'll definitely see with, again, the firms that are fund of funds or manager of managers, they can have more successive raises versus your individual direct fund, where the individual direct fund wants to make sure that all of the investments of the prior fund have been deployed in the most prudent fashion. If that's done, the performance will speak for itself, and that will take care of the fundraising in future cycles. Because another thing we see in this segment of the market is it's very relationship driven. So let's say, for example, we're in Vista Equity Partners. As you can see, their fund sizes have increased every time they've gone out to market. These funds are typically oversubscribed. In this environment, nothing's oversubscribed because everyone's worried about risk. But when things do normalize again, and things will definitely normalize, that's the one thing you can say with a guarantee, that the market will go up, the market will go down. So when things do normalize and there is an appetite for more private equity, this is the type of fund where you're going to have limited supply but excess demand. And that allows investors that already have a relationship to go into that type of fund. So the performance of the prior fund is essential for the survival of these entities, because the last thing they want to do in this highly competitive environment is lock up capital, have disappointing returns, and then just down the street, these guys are based out west, just down the street you can pick X, Y, and Z manager that will happily take billions away from them. So that's pretty much how that works from a structure standpoint.
You mentioned the fund of funds.
Yes.
Some of these are fund of funds or
That-
no? Or-
Yes,
okay.
that is correct. Yes, so yes.
Is the rate of return then net of all the fees or just the top fees?
So it is net of all the fees.
Okay.
So with the fund of funds, the bigger they've gotten, the more aggressive they've gotten to be in terms of negotiating the underlying fees. And then in terms of fund structure, you'll see that we don't list it here, do we? Adam Street is an example. You'll see that they have the primary funds, the secondary funds, which these are sold in the market, maybe at a premium or discount, depending on where we are in the cycle. But then co-investments, the co-invests are a really, really efficient way to bring fees down pretty meaningfully. So to have about a fifth of your fund in co-invest is a way to also keep the overall cost pretty competitive.
Quickly, the consistent focus of the pension committee has been on looking at managers in terms of being broadly diversified.
Yes.
Do you have a further breakdown of the ethnic percentages or gender percentages with regard to each of these managers in terms of what their diversification looks like?
So I don't believe we have the numbers here, but I can tell you really quickly that with Adams Street and Mesero, these are majority owned. You're not going to see much in the way of diversity. When I say much in the way of diversity, I'm looking at 20% plus in terms of the investment management team. So those are going to be less diverse in terms of firms that are being profiled. But then the flip side of that is Sango. You're looking at minority ownership there with Sango, with Exponents. That's a minority-owned firm, and then with Vista, that's a minority-owned firm as well. So of the 5 that we're profiling, 3 are diverse-owned and diverse-operated, and then 2 majority-owned and majority-operated. We can definitely, and I think this is one reason why also having the managers come in and present would also be helpful, because when you think about a manager like Mesero, is Mesero committed to making sure that its team is more diverse, over the next year, 3 years, 5 years, 10 years? I think hearing from the managers will also give you a sense of their genuine commitment to diversity. And then as a trustee, the knowledge of, okay, I'm investing in a firm that's majority owned, but these are the things they're doing in terms of making sure the tide is lifted. That is a very prudent discussion to have. And then on the flip side, you have a manager like Sango or a manager like Vista. These are diverse owned. Having the conversation with these managers, I think, will reinforce that we're not substituting any type of quality with going with these managers. You're going to hear from very experienced, very smart, very credentialed individuals in the private equity space. So again, I feel that the interview process will help further flesh out to the desires of the board what the composition of the private equity portfolio would look like. I would say, again, when we think about a private equity portfolio, it makes sense to have broad diversification, particularly if this is the first time you're going into the asset class. But that doesn't preclude adding, let's say, a manager like Sango or a manager like Exponents to that broad diversification. On the flip side, you have a manager like Vista that is diverse owned. And again, that can represent a very healthy portion of the allocation, thereby fulfilling the spirit of having diverse ownership, but also having excellent expected performance coming from that manager as well.
Okay.
Is there a minimum classification when you talk about splitting up the 10% of our portfolio that would have to go to a certain number of each of these different types? Because I assume the bigger ones probably have larger requirements. Some of the smaller ones maybe smaller.
Yes, so I would say in terms of the composite, I would look at maybe like 70-30, 80-20 between the broad diversified firm and then the niche strategy. So that's typically what we look at when we're building a portfolio with a core satellite framework. And then and I would say, again, 80-20, 70-30, those are good starting points to take a look. Now, as we talk to managers, they do exceptional jobs in terms of having fees as incentives and discounts and things like that. If, for example, having, instead of an 80-20, it's like 77 point whatever, and then the rounding goes to the smaller manager because it gives us a bigger discount. Those are some of the nuances we take into account when we're thinking about manager recommendations.
And when we look at all the different metrics that we could use to evaluate these different firms, are there frameworks that we can use for ranking structure so that we can quantify the differences in each one of these buckets, like fee structure, history, performance, terms?
Yeah, so I would say that we have, for example, this is where it's a little bit different from, let's say, when we've looked at the equity managers. Equities, you take a small cap manager, small cap, they're all in one category. They are managed to a Russell 2000 benchmark, and then there's a very specific peer group that they're measured against. There's a little bit more nuance on the private equity side, meaning it doesn't mean that we can't compare performance. That's what we do. We do compare performance, but on the flip side, we do want to take into account, for example, size differentials. If we're going in a much bigger fund, you're probably looking at more in the way of steady growth as opposed to exponential growth coming from the smaller allocation. If you're looking at a manager that has more in the way of global exposure, that global exposure may be more in the way of buyout, so that buyout may mute some of the overall expected returns. So it's a long way of saying we look at these tables as a way to compare the IRRs and the differences in performance. We look at distributed capital, we look at the remaining value, we look at multiples, and these are typically good indicators to compare one fund against another, because it becomes difficult to look at this from an apples to apples standpoint, because the managers are doing very different things when all is said and done.
But you can look at the apples to apples in terms of what our job is, which is to produce the return for the sewage and water board. Is there some metric that we can use to measure those? Like if you say, for example, if you put in 100% in Adams Partners, here's what you could expect. If you put 70-30 in that and Sango, this is what you could expect.
Yeah, so that will definitely come in. That will be reinforced during the manager presentations, but off the bat, in Adams Street, they're looking at a 15 to 18% net IRR. Masro is looking at something similar. You're looking at low teens as opposed to mid-teens for, let's say, a Sango, and then Vista, you're still looking at low to mid-teens. So that's approximately like where the managers are operating from a universe standpoint. And then really, as we think about slicing and dicing a portfolio, if the bulk of the portfolio is, let's say, a Mesero or an Adams Street, you can say, okay, 15 to 18% of the portfolio, that's about 80% there. And then the remaining 30% is targeting a 12%. That gives you a rough idea of where we're going for from a return standpoint.
And how much do we have to invest in this group?
So it's 10% of our overall assets.
Which is what?
So let me go off. I'm always mindful of.
I mean, are we big enough to invest in all these?
Oh, yeah, absolutely.
Oh,
So
yes.
it's comfortably over.
The
Yeah,
need to minimize.
yeah. So we're over
Because
30.
this gets us on our strategy that we approved already.
Okay.
Yeah, so we,
We have enough to go. If
Yes.
you want to go to Adams, you have enough money to meet their minimum investment. If you wanted to
Yes.
go to this one, you have enough to meet.
Yeah, I see what you're
Okay.
saying.
This
so
you would have enough to
approximately
meet their minimum
30
investment.
million-ish,
What's that,
I'd say.
30?
Mhm.
Yeah, we're
So-
not, we're not,
Okay.
we're not priced out of any of them.
No.
I understand that you're saying that the next step would be to interview managers, sure.
Right.
But
Yes.
I do think that having been in a lot of these evaluations, we are gonna have to have some more targeted metrics that have priority and weight to them.
Mhm.
While, some things might be important to look at, like diversification, that would be one of the metrics that would be looked at that would have a certain weight versus another. Like if it seems a little bit too complex to just be open-ended.
Yeah, no, so I would agree with that. I would say that as part of the interview process, one of the things, it's kind of like a job interview, right? Where you're scoring candidates or you're taking a look at the candidates and then you're looking at the returns, you're looking at the team diversity, you're looking at the track record, you're looking at the number of funds they've raised. So the interview process is actually part of that selection process we're talking about, bringing everything together. This document does, again, if we go through it, it will highlight a number of things. We look at fees, we look at number of funds that have been raised, we look at the IRRs, we look at multiples, what's been paid in, what's been paid out. So those are some of the quantitative metrics that we can rely on. I feel that bringing those metrics to life will be much easier during an interview, and that's, again, after the interview, there would be a deliberation. So it wouldn't be we interview the managers and we say, okay, on the spot you're hired. After the interviews, we would have to have a huddle, compare notes, and make sure that the weightings, the priorities, and what people find important are factored in. And I think there might be a question.
So the other.
He's asking for a
Because
score
I-
sheet.
because,
No,
like-
well,
So
I just to, as somebody that's been here for a while, and I was not happy with how it was when I started. This process evolves in that we are all different people that value different things, and part of what I think is important when you have a board or a committee that has to approve or ratify something is that you require different people that have different priorities to be satisfied to get that vote. So if you want to do a score sheet or a spreadsheet to make sure that you feel like you've done your process cool. If somebody else feels like I just need to meet the people and feel like they actually talk to me like I'm a person, that's not better or worse, cool to them. But I think there's place and space for everybody to evaluate and do their evaluative process in a way that works. And because this isn't something we have to decide right this second, it allows us time to reflect and do it, and everybody to do this however they want.
So this process is not done specifically like our procurement policy
Yes, it's not
process.
like that.
It's separate and different because this is the pension fund. So I know what you're talking about when you're speaking of our criteria and our spreadsheet and how we do the rankings. So this process is different than what we do in our selection evaluation process. But we can huddle later and discuss how we want to proceed during that evaluation process that will benefit all of the various directors or trustees.
Because there is requirements that we have as trustees for fiduciary responsibility, and there are
Oh.
certain metrics that have to be hit. And
Correct.
then there are additional considerations that we can also bring into the evaluation. So when you're in a board situation like this, when you have different viewpoints, understanding the requirements of where we have to hit, and then alternate considerations that we can take into account, and just understanding broadly what you can use to evaluate that, because there has to be some.
Well, I'm pushing a little back on that because the framework is our rules. Like the fact that we have 10% we have to use in this area is our rules. The fact that we have certain percentages we put in other areas is our rules. So this process is hanging on our rules. And so within the context of our rules, we're evaluating who's possible, which is why there's 5 and not 500. Okay, so there's nothing about this that we're considering that's not within our rules. So what I'm saying to everyone here is that this process exists within our rules. What each of us needs to do to be comfortable within the things that fall within our rules making decision is on each of us. And for some of that, it may look like a spreadsheet. For some of that, it may look like a personal connection. For some of that, it may look just like time for me to just read the stack of paperwork. But I don't think that anyone saying a way to do it and evaluating all the people that at baseline meet our criteria is right or wrong.
So I would say just as a starting point, if we view any managers we bring forward as blue chip managers that our research team is taking a look at, that's a good baseline to say, okay, there's been a set of eyes taking a look. Now, there should always be more than one set of eyes taking a look at things. But again, all of the managers being profiled, these are solid managers that have been in the business for a long time. The next layer, which I think makes a lot of sense, is, okay, how do we make sure that we're looking at these managers and making sure that if we hire any of these managers, there's a comfort level. So, you're watching CNBC and you hear something, you can go to bed and sleep at night well, knowing that, okay, this doesn't really impact the portfolio. And I feel that the qualitative component of things, which is interviewing the managers, and sometimes a spreadsheet won't capture this, where if you're talking with a manager and you can pretty much discern, particularly in private equity, someone that's slick versus someone that's doing what they're supposed to be doing. During the interview process, I would say, like, come with your hardest questions. Like, bring the hardest questions to make sure that those are answered in the most satisfactory way. Examples of, hey, what are your lessons learned? What are the greatest stories in your investment history? You'll get a sense of what's in the underlying portfolio. The presentations will also give a sense of firms that have been taken to IPO that were underwritten by some of these organizations, funded by some of these organizations. So again, as we think about forming the right decision, I'm not sure how hiring works at Swibno, but there's an art component, which is okay, what is the feel? Does this team really know what it's doing? Did they just look good on paper? Did they just luck the last 3 funds? All those things, passing the smell test. And then there's the quantitative component of things, which points to some of these indicators here. Now, to make life easy or easier for everyone, I can go back to my colleagues in research and we can think about putting together a scorecard or a cheat sheet ahead of the interview. So that way, again, you feel that you on the board, you all feel that you've got information equipped to ask the right questions, to rank the managers and so on. But I would say, yeah, definitely moving forward with the interviews doesn't mean that we've wedded ourselves to any managers, but moving forward with the interviews does mean that we're now willing to take an even deeper dive beyond what's in this report. And then following the interviews, if there's a feeling of, wait, I still need more than what I've gotten from this report and from the managers, we can kind of huddle and brainstorm on, okay, what are those things we can do and how can we accomplish it? But I feel that the interview process should hopefully flesh out some additional questions. And then again, I'll work with research to make sure that, there's somewhat of a scorecard. It doesn't have to be the decider in terms of what we do, but for those that are more quant inclined, we can definitely have, I don't even know if it's a weighting, but a scorecard that just shows
Well,
certain metrics.
Yeah,
that we
we've
wanna
done
take a
that
look at.
years ago when we interviewed certain managers, and we did have an evaluation form and metrics to do that, so that would be very helpful to us. But a follow-up question would be, in terms of process, we have to schedule interviews. What would be the timeline and the process in terms of whether we want to meet with all of the recommended managers in one setting versus doing them individually?
Yep.
My slant would be to try to see if we can come to an agreement in terms of a time when we could do them all in one day, but that's just my slant. But timeline-wise, what are we looking at? And we need to discuss as a committee the
So,
process of
we can't
whether
vote
we're
on
gonna meet
anything.
individually on that.
So we can't vote on anything, but what we can do is maybe send a survey out to the trustees
Mhm.
to determine what their availability is. And then we can do either a half day or a whole day,
Oh,
a
the
full
whole
day.
yeah.
And in that way,
That's what we did last time, huh?
I think,
Yeah.
I know
Oh,
we
wow.
did it
That's what we did
before,
last
we
time.
did a whole day.
And I'm gonna tell you, just for y'all to know, that there was some firms that came in, like you said, that were just, they looked really nice on paper,
Mhm.
and they were really not nice.
Yeah.
They were really not. It was, and there was no, you didn't need a score sheet to know that is trash.
names, please.
For those interviews, are we gonna ask them to say, this is what we wanna see, these buckets of information to allow
Yeah.
us to ask those
Absolutely,
questions?
absolutely. So this is
In advance or in real time.
absolutely
Yeah.
because the interviews, it's their time, but it's really your time. You are going to be the end client. You are the person that they need to convince that your dollar should go to. So yeah, your request would definitely get accommodated for the interview. Now, I do want to mention one thing. I want to be mindful of everyone's time as well, but I do want to mention that we discussed private equity.
Mhm.
That was perhaps more of a granular discussion, just given the nature of the asset class. It is significantly more liquid. You're looking at a pretty significant period of time where your capital is locked up. So again, with private equity, you think about the life of a fund, it can go up to 12 years. We typically, not typically, we look to avoid what they call zombie funds, which is they just never die, right? They every year they're asking for an extension in the life of the fund. These firms do not operate that way. So these are good institutional investors. You typically have your investment cycle, 6 to 8 years. There's the harvesting, and then they go back to market again. So on the private equity side, we've recommended bringing all the managers in, but we still have real estate and infrastructure to discuss as well. So with real estate and infrastructure, this is, in my opinion, a lot more straightforward in the sense of these are all managers doing something pretty similar. In the case of private equity, the private markets are huge, right? More companies have gone private than public in recent years, just because it's just easier to navigate. It's less costly, and so on. In the case of real estate and infrastructure, the type of real estate we're looking at, which is the mega open-end, Class A, liquid, prime market type real estate or infrastructure, it becomes very difficult for any firm to say, okay, I'm going to go and buy something on Saks or Fifth Avenue or buy this marquee building in San Francisco. So it becomes a much more finite universe that we're taking a look at. So while I mentioned the 5 managers on private equity, and I still stick by that, I feel that it's such a nuanced asset class. We want to make sure that we've heard from every manager and we get a clear sense of the different flavors.
Mhm.
On the real estate and infrastructure side, we can definitely shorten the list of folks that we want to bring in. So let me just do a really quick time check, and I'll, within the time accommodated, make sure that I go through those 2 searches, give you thoughts on the firms that we could also bring in to interview. We're probably looking at 2 firms to bring in from the real estate and infrastructure side, maybe 3. But again, I wanted to make sure that we close the loop on those searches as well.
And I also, again, just to emphasize, I'd like to see the breakdown of the ethnic composition,
Yep.
gender composition. I think it's important for us to have a total view of what that looks like.
So we do see that. We do see that here on the real estate side. Now, core open-end real estate, and I rarely ever say this, but this is one of the asset classes where you go back to core open-end real estate. So you're looking at portfolios in the billions upon billions upon billions. These were funds that were started from the insurance companies back in the day, so the Prudentials of the world and so on. They spun out their real estate businesses. So we don't have any diverse-owned core open-end real estate managers, but the best we can look for, support, promote, and hope for is increased diverse ownership or participation. So across all these managers, none of them are diverse owned, but you are going to see a breakdown of the team. Now, with the team, I feel that going into the interviews, we can actually ask for an even more granular breakdown between minority and female, because it's a pretty diverse world we live in, and a lot of people check a lot of boxes. So I just want to make sure that we get a little bit more color from the managers coming in. But on the core open-end side and infrastructure side, we are looking at less in the way of diverse ownership.
I just want to make sure we remain as a committee true to what we have said we're looking for, and that's why I'm asking.
Yes, absolutely. So on the real estate side of things, this is the memo for real estate. So we went through the memo for private equity. For real estate, this is the memo. These were the responses we received. So a number of responses came through. So again, we went through a lot of candidates, reviewed a lot of candidates, and then we are looking at these firms listed: Clarion, DWS, Principal, TA Realty, and Stockbridge. If we think about the 5 firms, we can bucket them into one category, which is core real estate. Core real estate basically means it's open end, so it's relatively more liquid than your private markets allocation. You typically have quarterly redemptions. The managers can put gates up depending on the market, transaction activity, and so on. But in a normal market environment, you're looking at quarterly redemptions. When we think about the core open-end space, you have your older, more established players in the marketplace. So think about Principal, DWS. I mentioned before, insurance companies have definitely had a monopoly or had a monopoly on the real estate side. So not surprising to see Principal in the mix there. Prudential, PRISA, they also have a fund. But then you have newer options that have come to the marketplace. So Stockbridge and TA Realty are an example of that. So Clarion, DWS, and Principal, your older, more established firms. TA Realty and Stockbridge, these are your newer core open-end firms. Now, when we take a look at these managers, you'll see here, unlike the private equity, we're able to list the managers and look at them under the same columns. Why? Because these are all managed to one benchmark. Private equity doesn't have a benchmark, so the managers, again, can take a lot of what they call idiosyncratic risk, which is just be very individual and be very niche in terms of what they do. The alpha opportunities in private equity may not be open to everyone out there, and that explains some of the differences. Now, on the core open-end real estate side of things, core open-end real estate has to invest in certain types of real estate. Core open-end real estate can only have so much debt. You'll see that the leverage is pretty low for this strategy. So for these types of strategies, it's usually in the 20% range, meaning that these managers typically own about 80% of the portfolio. So they're not levering up, they're not borrowing. They actually own these pretty marquee properties. In terms of size, take a look at the size of these funds. So TA Realty and Stockbridge, I mentioned that these are the newer funds. These newer funds are, 20 billion in the way of TA Realty and close to 16 billion in the case of Stockbridge. So again, very, very different when we think about this asset class. The more established funds, you're looking at 82 billion for Clarion, DWS 91.3 billion, and then Principal 97.9 billion. The number of employees, these are significantly larger firms. And then in terms of the strategy, gross asset value, net asset value, what's the difference there? One uses leverage, one doesn't. But you're looking at pretty high amounts in terms of market capitalization as well as ownership. In terms of occupancy, these aren't speculative real estate investments. So again, you're thinking of marquee properties that have good tenants, strong credit ratings. And when I say tenants, it's not individuals like me every month, asking the landlord for an extra couple of days. You're thinking about your Apples, your Facebooks, your Googles, and so on. And these are the tenants paying good money. Occupancy, again, is significantly high. Debt is a lower portion of the return strategy. So debt will always be part of a real estate investment strategy, even open-end. There are tax advantages to having some degree of debt. So we do see a little bit of leverage there. In terms of geographic weighting, these are US-focused funds. So, these are invested in the major markets, your New Yorks, your San Franciscos. Some of the newer funds, like Stockbridge, TA Realty, they'll be more in the Atlantas and the Austins and so on. But again, these are US-focused funds. And then
Question on the previous slide. On the geographic weighting, you see the Midwest is quite low. Is there a reason why? I mean, it's less investment in the Midwest compared to the other three regions?
yeah, and I can say this with love because I'm coming from Chicago. The Midwest has some metropolis areas,
Right.
but when you think about, for now, the heartbeat of commerce in the U.S., your New Yorks, your San Franciscos, your LAs, and so on. You have Chicago, which is an area in the Midwest. It's kind of weird saying this, but Des Moines is becoming a place to go. So Principal has relocated a lot of people to Des Moines, and I guess there's a big pull to bring people from New York to Des Moines. You can think about Austin and Atlanta to a lesser
Yeah,
degree.
I've seen how I wasn't expecting the South to be as high as it was.
Yep, and that's right.
I mean, high to the Midwest. To me, it would seem to be flipped, but that's why I asked the question.
Yeah, so if you think about the South, you've got the weather working for you, you've got lower taxes, and then you think about the Midwest, the winters can be unforgiving, and from a cost standpoint, perhaps not as cost effective. So that would explain some of that as well. In terms of performance, again, this is where the difference in private equity really comes home. So private equity, again, we showed each manager, each fund, and compared the funds. We're able to compare these funds against each other because, again, they all operate against the Odyssey Index. And what we're looking at is overweights, underweights, tilts to or against the Odyssey Index. Those overweights and underweights are a sign of manager skill or the manager's ability to read and navigate a certain market. So this, again, becomes more apples to apples when we think about comparing managers. When we think about who's out there, TA Realty, again, this is a newer manager. Stockbridge, this is a newer manager. So you're going to look at differences in geographic diversification, more in the way of your Nashvilles, your Austins. These managers were part of that wave and part of that ride, whereas Principal, DWS, Clarion, they've been in the West Coast, they've been in the East Coast, and markets that some folks are basically priced out of today, they were there essentially from day one. So that gives you a sense of the performance coming from different parts of the country. Now, when we think about the overall characteristic of a core real estate fund, the bulk of performance is going to come from income because again, go back to the occupancy, you look at 92, 97% occupied properties, it's going to be a cash flow play as opposed to an appreciation play. So appreciation will be less of a factor in the long-term returns, but there will be periods where appreciation or depreciation is pretty meaningful. If we think about 2008 as an example, depreciation was meaningful because we went through a financial meltdown sparked by the housing market. So prices went down significantly, but then there was a significant rebound because the market always overreacts, always oversells, and then when things rebound, we go back to either where prices were before, or if there are supply-demand imbalances, perhaps prices break new territory.
What's the difference between 2023 and year-to-date?
Where are we?
And the column heading,
There's
there's
two
like, it says income.
Oh, it's 2Q.
0.85 and year-to-date 1.64.
2Q. So it's a good question. So real estate is valued on a quarterly basis, this type of real estate. So these are the returns going out to 2Q. This is the 2Q.
Oh,
yeah,
okay.
2Q 23 return.
That's why he said he wanted to sit close.
Yeah,
He's like,
that's what
"Oh, no."
that's what I was worried about doing. So that's why I have my PC up.
I didn't see it either.
Sorry.
He's like, you're not gonna do that to me. I'm gonna sit right here close.
So when we think about real estate, the fees here, you're going to look at fees pretty much uniform. It's going to be more than what you typically get, what is typically charged on the traditional side. But as we think about these managers, again, these are all solid managers, really good in terms of what they do. They're a little different. So again, TA Realty and Stockbridge, I would lump them in as doing a very similar thing. And then with Clarion, DWS, and Principal, I'd also lump them in as doing something very similar. These are your more established managers. So I'm going to pause and just get a pulse check just to see, okay, we're going to interview 5 private equity managers. We can do a couple of things. We can interview all these managers, or we can interview a subset of these managers. If it is a subset, I can give you some thoughts around what the subset should look like, but let me pause and see what your thoughts are there.
So because we have no action items, it's just presentation. So we may have to come back for
That is
another
fine.
meeting to put that on the agenda
That is
as an
fine.
action item. But for right now, I think we do the presentation. And
Okay, perfect.
at some point, we can determine, board relations can actually send out informational email to see what the availability of our team, of the pension committee for a meeting, what we want to do the interviews on a half day or a whole day, based upon you all's schedule.
Okay.
Can you remind me of the asset allocation, the percentage on, that we're looking for to fill with this?
With real estate?
Yeah.
Real estate's it's 3%. So it's a small allocation. And then with infrastructure, it's 7% for infrastructure. So slightly bigger than real estate, but less than private equity. So all lumped in together, it's a pretty meaningful combination within the asset allocation. And this takes us to the last segment, which is infrastructure. We've gone through real estate. Infrastructure, think about your, I'm at the Sewage and Water Board, so know your audience, right? So I'm at the Sewage and Water Board, but infrastructure, ultimately, I'll give you the elevator pitch. Infrastructure, really, you're looking at essential goods and services. Now, this is an asset class that is relatively newer in the US, but it's been around outside of the US for decades. Why is it new in the US? We have a pretty robust municipal market in the US. So the municipal market has really covered a lot of what the infrastructure investment space does. But if you go back to, this is when I was a kid, back in the 1980s in England, there was this lady called Margaret Thatcher. She decided to privatize a lot of things. And the privatization of British Airways, the gas, the petroleum company, that open people's eyes to, wait, we can make money from infrastructure and still provide essential services, but still be regulated to make sure we're not gouging prices and so on.
And that's a question, I was waiting to get the infrastructure, is that what you just said, infrastructure I'm thinking infrastructure in the United States, large portion of it is publicly owned, I mean, public assets, but from the infrastructure fund, what are these firms, I guess, on the private infrastructure side, number one, and then the types of infrastructure we're talking about with these large investments, and I saw with JP Morgan,
Yeah.
I mean, they're right at 2.4 trillion, which is tremendous. So just if you can give a quick overview of the types of infrastructure, is it more on the private side and the public side, or a combination of both?
It's a combination. So all of these managers, this is all private infrastructure that we're going to invest in.
Private, okay.
So this is all private, but many of these firms will have listed infrastructure, which is kind of like we have Cohen and Steers in the portfolio.
Okay.
That's an example of the listed infrastructure. That's the public infrastructure. These are the stocks of infrastructure companies that trade on the stock market.
And I guess the types of private infrastructure.
Yes. So with JP Morgan and IFM, these are your more established managers. You're looking at airports, toll roads.
Okay, yeah.
We don't, and again, this is where interviews are great.
Mhm.
We don't want to be profiting off prisons or
True.
things like that in our portfolio, right? So this is where the interviews come in, but we're looking at toll roads, we're looking at airports, we're looking at what they call greenfield, brownfield investments, so power plants and things like that. And ultimately, this is where these managers do invest. Now, as an asset class, you're looking at a global opportunity set. So these managers will invest both in the US as well as outside the US. And that helps from a pricing standpoint, diversification standpoint. From a political risk standpoint, you're looking at very mature markets like Australia, the UK, other parts of Europe where they're investing. So if you think about Heathrow Airport as an example, Heathrow went through a massive expansion. The Vienna Airport went through a massive expansion. IFM was the owner of that, and they were able to finance that expansion. The receipts that they get, the income they get from the airports and the users, that's basically the income that goes back to the fund. So in the interest of time, I'll just say here with infrastructure, particularly this type of infrastructure allocation, the goal is to have a steady return stream and some degree of appreciation. So it's a subset of the real asset class. So real assets is comprised of real estate and infrastructure. This is a diversifier to the real estate segment of the market. Unlike real estate, you would expect to see less in the way of like lulls and then big spike ups in infrastructure. It should be more of a steady return stream because these are essential goods and services. We're in real trouble if essential goods and services become something that are prone to like just big economic cycles. So from a return stream standpoint, that's why we have a bigger allocation to infrastructure than let's say real estate. And that would help also dampen some of the volatility we'd expect to get from the equities, fixed income, and then even private equity during the early years of those managers investing. But these funds here, you get a sense of what they invest in. Utilities, I'm not going to over-explain what utilities are. You have wireless, airports, toll roads, and then depending on the manager, you're going to see some managers will venture out across the whole spectrum. Other managers are going to be very specific in terms of what they do. I mentioned airports before, so IFM, Vienna Airport, Heathrow, these are examples of the types of projects that these managers will be essentially invested in. In terms of the investments, these are very large portfolios. Now, the more established managers, and my recommendation, I know we're not taking we're not going to make formal recommendations, but my recommendation, particularly when we're looking at asset class for a portfolio of our size, would be to go with the more established manager, the more broadly diversified manager for infrastructure. Because, okay, on the private equity side of things, the ceiling of what you can get is worth the risk that you're taking. In infrastructure, the ceiling of what you're getting is really the ceiling of what you should be getting. So we don't want to be taking too much risk, particularly on pricing or buying into the market at an inopportune time. So if we look at the managers we're profiling, IFM and JP Morgan stand out as established. They've already got established portfolios. Unlike Brookfield, Macquarie, and Stonepeak, that are beginning to acquire and build their portfolios. Morgan Stanley and IFM don't have, they've already built their portfolios. So if you think about the market now, where interest rates are now, it's going to be more expensive to acquire an infrastructure asset today versus a couple of decades ago. And these are some of the considerations we'd have when we're looking at managers. So in infrastructure, we'd recommend looking at just the two. But as noted earlier, I think the goal is to profile or get dates from the trustees to see when we can have interviews. And then as those dates are secured, we can establish what would make the most sense. It could make the most sense to at least start off with a private equity because we have those 5. And then if at that meeting where we're able to make decisions and have formal recommendations, we can have a formal recommendation on the number of real estate and infrastructure managers to bring in. I think 15 managers, as much as you guys love me and you want to hear from me, I don't know if you want to sit through 15 manager interviews. So maybe at that meeting, the private equity meeting, we can also just have a quick session there if the statute or rules allow us to, and then we can look to have a whittled down list. And hearing from some of the trustees around just having a cheat sheet or a scorecard, we can maybe look at adding that to the reason or the rationale for having a smaller number of managers for those asset classes.
And is the goal to assign the 7% asset allocation to one manager?
So I would say we could definitely look at 1. 2 could make a little bit more sense, just given the fact that 7%. And even the best manager out there, you can take Warren Buffett, an example of one of the best to have ever done it. Even he has a bad spell here and there. So having 2 managers, particularly for a new asset allocation, makes sense because hopefully one will diversify another if there is anything unexpected. So that would be the thought on this end. 7% in 1 could work, but again, for the reasons just mentioned, I think we could go for 2.
And is $1 million enough for even these large?
Yes, absolutely.
Yes, we established earlier, don't bring me anything I can't have. So if there's a fund that's great, but we don't qualify for it, please don't share it with us. Because that makes me sad.
Okay.
Oh, and to the question earlier about this is just the performance report. So apologies if I've already cracked this joke, but I literally do threaten my kids. I'll say I'm gonna go through one of my performance reports tonight if they're acting up because there's so much information here. But this does provide really good information like peer group rankings on the managers. We look at calendar year performance as well as annualized performance. So the calendar year gives you a sense of how steady the returns have been. Annualized can give you a snapshot in time of how the manager's doing, but was it skill or was it luck? The calendar year returns give you a good sense of that. And then we take a look at the fees, relative to peers and so on. So the report provides a little bit more data with respect to what's doing well in the portfolio and why it's doing well. And if anyone's underperforming, it also just gives us the rationale to say, look, they're underperforming, but we don't need to fire them. This is why. And this is, a useful bit of information.
Chairman, could I ask, if you wouldn't mind, just quick, would you mind sharing with Marquette's experience with setting up the manager interviews logistically? If it's like an hour or a half hour, is there an optimal way to ensure that? Because I'm sure these people could speak an hour or 2 each.
Oh, yeah, no.
What's
So,
the best,
so we usually do.
We have limited them to
we
time in
usually
the past. Yeah.
i'd say like 25 minutes with 10 minutes Q&A or 20 minutes with 10 minutes Q&A. That's usually what we do for the manager interviews. Now, if for any reason during the interviews it's just such a split between who we want, we can always have another round, but usually 20 minutes or so with 10 minutes Q&A typically suffices.
I think we've tried to limit it to maximum 30 minutes, including presentation and question and answers.
Okay.
Of course, that's still something we can decide, but just want to give you what we've done in the past.
That's 4.5 hours.
And so it's gonna be it's a half day only thing for that.
And it
We will
does
make
go back.
sh- Yeah, and we will make sure that we could do it virtually. I mean, if
Yep.
it's the pleasure of the
Yeah.
committee that we could just do it virtually as opposed to flying, having these people come in.
Oh, I don't care about them coming in.
Okay,
I want to see them.
okay, okay.
Yeah,
Oh, this
I-
is
I
enough
thi-
money.
I
I
think-
need to see them. No.
yeah. I think our experience has been just that, to see them and physically interact and ask the questions with them in person. Yeah. Okay. Okay, Kwaku, thank you so very much. Is that it?
That is just half of what I was going to say. So the other So no, that is it. That is
Thank
it
you
for
so
my-
much, man. I really appreciate it. All right, there are 4 information items for the committee to review. Manager responses for each of the areas we have discussed. And there's a supplemental investment report. So with that having been said, do we have any public comment?
No public comment, Chair.
No public comments, then I'll entertain a motion for adjournment.
So moved.
Second,
Seconded.
moved in second. All in favor?
Aye.
Any opposed? Meeting is adjourned.